You and your team at LPL Research have created the Road to Recovery Playbook. Want to open that up now, if you would. First of all, what's the reason behind it? Why do you guys create it? What is it, and what's inside it?
Yeah, Scott, we released that 3 weeks ago, and the thought process behind it was, okay, stocks are down 30%. Do you just buy? No, you absolutely don't. Now, history would say when stocks are cheap like that, you hold for 3 or 5 years, you probably will make some gains, but we didn't want to just blindly say that. So in 2008, before I was there at LPL, Burt White did create some type of a Road to Recovery playbook. I forget exactly what he called it, but that's what we're calling this one. 5 different things that we're looking for. Things like, are we in a recession? Yes, last week's 3.3 million people losing their jobs confirmed that. Look what the market did last Thursday on that news. Went up 6%, right? It's almost like the market hates uncertainty. It can take bad news. It can take good news. But the bad news over, yeah, we're in a recession, market actually bounced on that. Well, the one thing, so sentiment is washed out, technicals are washed out, we have benefits from fiscal, monetary policy. Those are all check marks in the good and the positive. The one thing out of the 5 things we're looking for in our playbook that's not there yet is a peak in the U.S. Cases of the COVID-19. If you look around the globe and kind of follow forecasting, we're probably about a week and a half away potentially from that. But once we can get that to happen and the cases start to decline, like look at Seattle, right? Seattle is where the first big city to get hit with this. It's starting to see some good news. Spain and Italy both have decreasing new cases. So there is light at the end of a very, very scary and dark tunnel. And those are kind of the things we're looking at. But all in all, what we're saying just this week, guys, yesterday we went to overweight equities. We've been market weight equities for a year, since March of last year. We're checked off 4 out of the 5 on our playbook. We think that's good enough for us to say, you know what? We think stocks in the next 1 to 3 years here look like they should really do well relative to bonds. And that doesn't mean blindly go buy across the board, but in the money that we run, we are actively looking to start to add some equity exposure here.
Ryan, you mentioned bonds. I want to go back to that for just a second because there's a great amount of transparency in the public eye in the stock market. All you have to do is turn on the TV, pull up the internet, and you can see what's going on in the stock market. Not so much in the bond market, and that's really very almost a mystery to a lot of people. What kind of effect is all of this having on the bond market, especially all this stimulus money, and where do you see that going?
Yeah, well, the bottom line is 2 weeks ago when the stock market had a massive, massive sell-off, gold got hit really hard and bonds, which are normally safe, right? Fixed income's normally safe. They got hit as well. Then the Fed came out and said, okay, we're going to be the backstop. We're going to buy all these different types of debt, whether it be municipals, whether it be munis, whether it be commercial municipal bonds, corporate bonds, all these different things. And some of those bonds really bounce back on the news. But the bottom line on bonds here, for the year, the treasuries are up almost double digits. Okay, that's the longer end of the curve, but most bonds are higher on the year. If you look at the Barclays Ag, which is your average bond here, with stocks down 20%, so that's a nice diversifier. We still think in any portfolio, there's always a place for fixed income. But again, if you asked us what's going to do better the next 1 to 3 years, stocks are historically cheap relative to bonds. So we're going to be siding a little bit with stocks here. But I mean, hey, bonds, when we've had volatility before, they've been a good diversifier, and we still think they will continue to provide that to a well-diversified portfolio.
Ryan, if you're thinking about the individual investor and they were already in the market, so to speak, they were already invested before all of this hit, and maybe they're early in retirement or they're coming up, with retirement right around the corner, what would you say to them? What advice would you give to that investor?
Yeah, well, obviously, if they've had equities and they've written it down, the way we would say is this: don't panic yet. And what I mean by that, the average bear market corrects 37% when you have a recession. We just went back 34%. We definitely think we're in a recession here. So could this get worse? Could we have a 50% correction like the previous 2 crises? I mean, it's possible. But again, when you look at the benefits of fiscal and monetary policy, the historic stuff that we just talked about, to us it makes sense. If you can look out into the future, there could be a lot better returns the second half of this year. So again, that's why they have guys like you guys, right, to help people from helping themselves. I mean, one simple thing that we're looking at doing right now is just rebalancing, right? People have less stocks than they did a month ago relative to bonds. Maybe just simply a little bit of rebalancing in a portfolio is what your average investor should do right here and now.
Final question for you, Ryan. You mentioned making the shift to overweight in equities as we look at this next 1 to 3 year time horizon. Are there any areas, particular investments that your team is looking at that might be a good opportunity?
Yeah, Scott, two areas we like and we've liked for a while and continue to like: technology and healthcare. Technology's been a true market leader. Look at the big names. They continue to make money, that have done very well. Those are still areas we like. And healthcare, when you look at all the different things going on with this virus, but just so many potential as people continue to age, those are two strong groups that we really like. And I'll leave it with this, and I hope I don't butcher it. Warren Buffett said, about every decade, when skies get dark, it rains gold. The best thing you can do is get your buckets ready. We think investors should be getting their buckets ready here and now.